What up, chat? Oh, man. What a wild weekend. I took Friday off to do some stuff with the family. Felt a little off all weekend long, and then the Iran controversy started, and it's been a wild ride to watch the markets. For everybody who's been watching alongside myself over the weekend, I'm sure you're a bit, I guess, emotionally thrown off by everything you're seeing, and you want to know how this impacts you. We're going to cover that on today's show. We're going to talk a lot about how this impacts every single one of us and what to expect from the markets from a fiscal perspective. I don't want anything right out the gate to be lost on the idea that controversies like this do require bloodshed. They're not good. Wars are bad for everybody. And there is no positive spin other than the fact that hopefully change that is good will ultimately come from it. But this is, as it seems now, far from over and very tragic. So, with that, before we start the show, this show is lovingly brought to you by the team over at Fridays. Go to joinfridays.com, use code HIGHER if you want to support the show. You're going to look at GLP-1 medication, longevity stuff. It's all the good stuff that you need to live a healthier, happier life. I currently take NAD Plus from them, as well as microdose tirzepatide, which I think has been very, very helpful to my overall mental status. That being said, go to joinfridays.com, use code HIGHER. You'll support the show, and we will appreciate it. The chat is back up and working again. For those of you who watched on previous shows, you know that some of this stuff has been a little bit technically challenging for us. I should probably explain as to why that is happening. We are incorporating AI in a much more broad sense in the show, bringing AI agents onto the show to help us facilitate a lot more. Think of our entire news desk behind the scenes being active with AI agents as opposed to being run by humans, which will be a really cool thing that I will break down on another show at some point in time. If you are fans of the show, watch tomorrow's Tuesday episode, particularly if you're interested in AI and the impacts on the economy. That show, which we recorded, I want to say on Thursday of last week, is going to be a really good one. I think it's a very powerful episode and is really meaningful. And I think all of us should be aware of some of the repercussions we're going to see here in a future business type scenario that we're going to get from that. So before I get too far down the path of all the exciting things, Let's get into the market. I think everybody's really concerned about what's happening and what's going to impact all of us financially. We are still, ironically, in a tech-led rally. The market, I think a lot of people thought was going to open up somewhat bearish, and yet it hasn't. It started off a little weak in the very beginning, but then kind of boosted back up. This is our risk profile of the market. This is the market status, if you will. And the reason why we do this is it gives us kind of an overall perspective that we use throughout a sector by sector analysis, which you can find down here at the very bottom. This is telling us that currently we are not seeing a defensive risk off or liquidation type event, that the market is in a wait and see approach as to what happens. You will not see the same for oil stocks. If you've been watching my X feed or my Threads feed or any of the social platforms on Instagram, you'll find it in the stories. I talked pretty early on Sunday about how you should expect to see a minimum of $3 to $5 a barrel increase in oil, and could go as high as the high 70s. Matter of fact, it did cross the $80 mark and then came back down a little bit in response to a lot of what we saw. We will get into Exxon Rosie here in the not too distant future, and we will cover some of the oil and energy sector stocks. I think the Strait of Hormuz is going to be impacted for a prolonged period of time. The president came out in a statement not too long ago and said that he fully expects this war to continue for at least several weeks leading up to what presumptively is a meeting with President Xi from China. And I think there's going to be a conversation we need to have about China's implications here, the oil supply, and how China all plays into this bigger picture that I think not a whole lot of people are talking about, that I think is meaningful and important for us to understand from a fiscal perspective. Again, this is a finance show. This is not a political show. We are here to talk about the implications to the economy. Let's look at the risk index for a normalized market. In a wartime scenario, this is actually positive. We're seeing this come down from calm where it was into the normal territory. This is our proxy for the VIX. And for those of you who want to understand where the VIX went, the VIX popped into about the 21 range over the course of the weekend. Anything above 20 in my mind is elevated risk. Our synthetic volatility index continues to show a relatively healthy, normalized perspective when it comes to investing. So I don't think there's anything in the markets right now that's scaring anybody out. And you saw that with our market status here. We're in a bit of a tech-led narrow rally, which is really being propped up by, ironically, the Mag 7 stocks are kind of boosting again, despite all of the fallback that we saw in the CapEx spending the last couple of days. Let's go to the liquidity pulse index. This has been interesting to see change. The Treasury account is now supportive. That has been the most meaningful change we have seen. Our net liquidity level is still at a drain, but we're seeing our liquidity position improve from the Fed. And this has a lot to do with the Fed pumping the markets like they said they were going to do with the repo line ahead of what they call tax season, kind of a boost, if you will. It wasn't what I would call quantitative easing by any stretch of the imagination. It was non-QE, QE, if you will. But we're starting to see the implications of that money trickle through the financial system. So we have seen this improve from what I would call restrictive and drain into a tense position. As you start seeing more liquidity hit the system, you're going to see it run into supportive and possibly even a flooding of the scenarios. But do not expect the Fed to do this anytime soon. Traditionally, during wartime efforts, you've seen the Fed hold. In the wait and see approach that you've seen them say historically in the last couple of years, you're going to see them say during the wartime initiatives. Wars can be, if it goes on for a prolonged period of time, inflationary, largely due to the government spending and supply constraints. However, what we are seeing in this particular market is a bit unique on a lot of fronts, and we'll get into that as we go through the show. But liquidity pulse index has improved, and you're going to see this and it dovetailing into some of our forecast modeling that we do later on in the show. Home affordability is still stretched. Supply constraint has actually kind of pulled back a little tiny bit, but you have seen, because of the rate improvement in recent days and weeks, you have seen mortgage payment burden and mortgage rate pressure ease slightly, showing that this is now less strained and more in a stretched position. So by all outward measures, and it sucks to say this during a war where it's impacting a lot of people, that our economy seems to have gotten better a little bit in the last couple of weeks. And I'm not doing anything from a political perspective. I'm not giving you an opinion. I'm just telling you based on the metrics, just purely from a mathematical perspective, lower rates has improved home affordability. You've got a Fed which shows increased liquidity. We've gone from restrictive into tense. And you've got a status of the market which is, again, in a tech-led narrow rally. So by all outward measures, what could have been a catastrophic and feral open to the markets on Monday has seemed to be okay. I'm not saying this is great, but it's not bad either compared to what it could and likely should have been. Let's look at the macro schedule of events that have happened this week. You got ISM manufacturing data out today. We've got the JOLTS job opening report coming out on Wednesday. Again, that is the Fed's preferred metric. Non-farm payrolls, unemployment rate on Friday. I think that's going to be a much bigger one than I think most people expect. Unemployment rate is an important one there. You've got inflation, core inflation rate, and PMI stuff next week. So keep in mind this week you want to look at JOLTS, you want to look at unemployment rate. Everything else can frankly be somewhat negligible to the overall factor of the economy. So this is where we're going to see the most meaningful change and the most surprising stuff in the markets. So this is the one that caught me a little bit off guard. And if you're watching, feel free to give me your input and thoughts on this one, because I've been watching this one myself most of the weekend. The major home builders, D.R. Horton, Lennar, Pulte Group, Toll Brothers, and NVR, despite the fact that interest rates have come down, have not seen a meaningful improvement. Despite the fact they are rate sensitive and the fact that we have seen improved interest rates, you are not seeing the home builders improve from a stock price perspective as it appears right now. So that is contrary to popular belief. And I think this parlays a lot into what I've always said on the show, and it is highly disputed that affordability is a bigger problem than rates are. And if you look at the home affordability index here, oops, I gotta make sure that happens here. Look at the home affordability index here, and this speaks volumes to that, right? So if we have supply, which is there, and affordability is improved incrementally, you still have a stretched home buyer, and there's caution to this. Now, this might improve in the coming weeks and months as the lower interest rates that we saw the last couple of weeks work their way through the system, and housing is a lagging indicator. But as of right now, the housing home builders sector does not appear to be improving materially despite lower interest rates. That could and most likely will change in the days and weeks to come. Banks in this space seem to be faring okay. If you've been watching the show for any prolonged period of time, you know that Saeed and I tend to believe in the banking sector as it is right now. You're going to see a pretty healthy push from them. The community regional banks will see M&A activity. CRE, real estate, and REITs. I believe in the REITs. I think the commercial real estate market will continue to improve. They will shift their focus from one property type into most likely data centers, given where the market is going. But certainly not a lot of change in structure here on the refinancing risk side. If anything, the refinancing risk has improved as rates came down. We are seeing some treasury spike. We're going to go over that here in a little bit as well. Let's look a little bit at the mega caps. These are, in fact, leading the way. The Mag 7 is leading the way of a narrow tech-led rally. Obviously, Amazon being slightly off and Alphabet, but Apple, Microsoft, NVIDIA all doing pretty well. Particularly NVIDIA seem to be scaling pretty well in this market. Let's go over the consumer sentiment. This is one that I'm the most curious at. This seems to be down. And this is going to dovetail a lot into what you see in the housing sector. I think the consumer is scared. And I think because of that, you're going to see some of these spaces pull back a little tiny bit until we get a little more stability in the economy. The industrials, meanwhile, are up. Caterpillar, Deere, General Electric, Union Pacific, 3M all seem to be doing pretty well. 3M obviously being the outlier there. And I don't really know why. So let's take a look at 3M's stock ticker and their performance, because I haven't been watching it today. But if anybody knows why, let me know. I will generate that chart real quick. Let's pull it up here. So yeah, they're down. I mean, from market open, not too bad. It doesn't look terrible. Let's look at the 5-day. Yeah, so 5 days pretty rough. So it looks like I got some homework to do on 3M to figure out what's going on with where they're at and why. Okay, so over the course of the last month, you've seen some improvement. I mean, they're definitely not near session lows, but they're not near session highs. They're coming down here. So it's probably an earnings play. I'll look into that and get back to everybody on why that is the case here. Let's get back to the sectors a little bit. And I appreciate it. I apologize if I'm a little somber in today's episode. It's been a little bit of a long drag of week in the energy space. Yeah. Okay. We're going to talk a lot about oil and why this particular exposure here is going to see some change dynamically through the Strait of Hormuz. And I'm going to speak to you from a timeline perspective where I try to do away with the politics and explain how there's a systematic change here that needs to be taken into account. And then, of course, go into the defensive real quick as a Dr. Gap. Anytime we see fear in the markets, and if the market weren't improving, you can expect to see that if we were in this risk-off liquidation or defensive position, you would expect to see these perform well. These are our defensive stocks. We saw that recently about a week or two ago when we saw the market hit that way. Okay, before I do anything else, let's get to the comments real quick and see who's out there. Sean, Can Pop, sorry I missed the last two lives. We had our 10 new kennels. Oh, wow. You are being played installed this weekend. Yeah, Sean is an investor in dog kennels, him and his wife, and he does pretty well with that. You guys come to the Central Coast, let me know. I'll give you a tour. I would love that tour. And Saeed and I both need a vacation, so I would love to drag his ass to the Central Coast if possible. Let's see what else is out there on Instagram. Rosie, 3M is undergoing major litigation in Minnesota, water issues. That's interesting. I will have to look into that, Rosie. Thank you for sharing that. I did not know that. Let's see what else we got here. Okay. So I'm going to get into the XAI model. It should come as no surprise that the first thing right off the top is a U.S.-Iran military conflict. It is the most talked about thing in the social sphere, and it should be, according to, and this is, so if you're new to the show, the proprietary models work this way. It scrapes Instagram, it scrapes X, and it comes up with the most talked about topics and gives us their impact on the markets. This is purely binary. This is not going to be something that we have had input on. AI curates this, so I will read you the overall context and then come back with AI's controversy score here. So, Trump administration escalates military operations against Iran with bombing campaigns and naval deployments causing widespread market volatility and geopolitical uncertainty. Yes. Despite initial panic, markets are recovering quickly, suggesting Iran's conflict may be more contained than feared. Watch oil price normalization as key reversal signal. And we are seeing exactly that. So we saw the markets look stable. We saw oil prices appear to be stable in the sector chart here. I'll go back to the sectors. We saw the oil prices seem to be stable here. If I go over to crude oil, you're going to see crude oil come back down, I think, from what I last checked here. So this appears to be right. But let's just let's not assume we're 100% right. Let's go over here and check the numbers here. So on CNBC, one of the places I always tell you guys to check, that's the whole point of the show, is to teach you guys what we know. I'm going to do this while you guys watch, so we see it at the same time. I'll go over to the screen here. This is CNBC. If you want to see where oil's at any point in time, you literally just click on oil at the top. You go to oil here. It's come back down. It did start up as high as 80 at one point in time. I think it came back down a little bit. So now we're seeing WTI crude around 71, which frankly is down a healthy amount from where it was at one point in time. So let's see. Here's where we are at 73. Okay, so yeah, again, we're not seeing any wild spikes in crude oil, at least not right now, and everything seems to be normalized. Let's go over to the 10-year. I think the 10-year Dow Jones is down slightly, but let's look at the bond market. Bond market shows 10-year up incrementally, so we are seeing the 10-year creep up a little tiny bit at 405. So pretty healthy returns. We saw a little bit of a dip as the weekend kicked off, but certainly nothing that's scaring me. Now, this is something to keep your eye on here as you see this growth continue in the 10-year space. That's going to drive 30-year mortgage rates back up into the low 6 category from where they are today. So keep an eye on that as we see this play out. I do want to go over a little bit of a map of the region, which I suppose I could probably do now while we're here, because this is the first topic of the day and it does deserve the attention of everybody. So I'm going to go, if you guys saw on my profile this chart, I'm going to show you a little bit. I took it from CNBC. I'm going to go ahead and pull it up here and put it on the big screen. All right, so one of the things that we need to be honest with ourselves, intellectually honest with ourselves, is the timeline of events that occurred. Okay, and before I get to this chart, actually, let's spend some time talking one-on-one here. Number one, Venezuela happened. Venezuela has a huge crude oil reserve, and we went in and we took out Maduro. And at first, that looked like taking out an evil dictator who needed to go. And the streets seemingly very happy. There wasn't any pushback, and it just happened. Well, that opened up a huge oil supply, which can and does come to the United States, which does have crude oil refinery, most notably in Louisiana and Texas. Strategically, that was step one. Step two, I thought the same weekend that they took out the cartel member, the head of the cartel, the new Jalisco cartel, that we were going to see some type of action in Iran that weekend. And for reasons that are unbeknownst to all of us, that took place that weekend. And it seems as if, looking back on in retrospect, that allowed some of the foreign ambassadors to leave the consulates and other places where they had political allegiances and vacate other areas in the Middle East before attacking Iran. And then they had some intel, it looks like, where they had the leadership teams isolated to certain places, and they subsequently bombed this last weekend. Now, what this does is creates an interesting problem because now the U.S. has an oil flow that is less dependent than it once was, and it was already light dependency on the Strait of Hormuz, which is, if you don't know, this region here. So you've got Iraq, you've got Iran, you've got Saudi Arabia, you've got Oman, Abu Dhabi, Doha, all surrounding the Strait of Hormuz. And the Strait of Hormuz is just this little area right here. But as you see, the land mass comes up together here and into this space, which is literally running all along Iran's coastline. And because they can pinch down this space, they can stop the flow of oil, which leaves the strait and goes back out to everybody else. And the large majority of this goes to China. There is a set of circumstances which you cannot deny as it relates to this. Now, I'm not saying that Iran was attacked for ulterior reasons, but certainly there is a benefit to the U.S. in doing so. And let's go over some of those numbers here, okay? So those numbers are the Strait of Hormuz moves roughly 20 million barrels of oil per day, okay? 20 million. About 20% of the global petroleum liquids consumption. About 84% of the crude and condensate flowing from it goes to Asia, most notably China. With tanker traffic already disrupted and major shippers suspending movements, I would not be surprised to see WTI crude trade above $70, where it currently is today. Now, the reason why this is so important is this last sentence here. About 84% of the crude and condensate flowing from it goes through China. So this oil supply, which is now seen at least restraint, and people are pulling out because insurance carriers are concerned about the region, and I'm sure the U.S. is going to try their hardest to keep it open, but largely supplies China. The timeline with which we've been given about this entire event occurring and how long, it says about 3 to 4 weeks, is what the White House is saying. Well, 3 to 4 weeks also aligns with the United States' president meeting with President Xi of China as well. So now China has had their oil supplies cut off. We have had a crude oil import being brought to us vis-a-vis Venezuela, and now this happens. You cannot deny that those discussions are going to be meaningful and will have some impacts on their country in the near term. So I think that there is certainly some geopolitical conversations that are taking place as it relates to oil and the control of power vis-a-vis money in that region that is not being discussed enough. And there is enough reason there for China to be concerned. I'm sure they have an oil reserve and supply the same way the United States and many other countries do. But certainly this is going to be provocative in the oil space financially in the days, months, and weeks to come. So I'll pause there for comments if anybody has any comments. Saeed, I see you out there. Back at it again. What do you got here? Samson, stay in the markets, DCA through thoughts on using Acorns and Robinhood. Well, we'll take a little sidebar there. Let's do some of that, shall we? Let's talk about something positive for a little bit because my day has been real grim and dark. Let's see here. Thoughts on using Acorns and Robinhood. I use both. I use Acorns using basically their roundup feature on my credit cards. And I also include $50 a month as well. On top of that, I think that account, when I started it several years ago, I think it's currently around 50,000-ish or so. And that's just an account that I have that's out there. I don't really look at it a whole lot. I'll probably use it for my son at some point in time. But I haven't really kept a close eye on it. Robinhood, I use it for the crypto markets. I'm a big fan of what Vlad and his team are doing over there. I use it because I just wanted to understand the infrastructure, the app, and how it works. But I started buying Ethereum and Bitcoin in it a long time ago. I did sell down both of them, but I still use it from time to time and keep a pretty close eye on the crypto markets with that app. Most of my trading, however, is done on Fidelity. Let's see here. Saeed, let's see here what you got in the comments. Even though we are largely energy self-sufficient at this point, the stop of flow from the Strait of Hormuz is a huge disruption because it is viewed as a benchmark to setting the price of oil markets. Yes, but China is much more dependent on that oil supply than we are. There are other places to get oil, Russia, for example, and some other parts of the world. But certainly, this chokes down about 84% of the production that came out of there went to Asia-specific markets. So certainly, there's going to be reverberating ramifications in the market. Blah, blah, blah. 5 stars. I appreciate you, Samson. Sincerely appreciate it as always. You guys have come to the Central Coast. We already covered that. Let's check out the Instagram comments. I haven't checked over there in a little bit. And I apologize if I'm not. Again, my enthusiasm level today is just low. I've been kind of down all day long on this stuff. It's been hard to watch. Let's see. Everybody on Instagram okay? Yeah, looks like you guys are all good over there. Okay, so let's get back to the show's major topics here. So again, we've seen the war. We've seen this breakout. Treasuries did spike down. I'll go back over here to the wider screen. You saw this happen over the course of the weekend. We saw the 10-year come down to about 3.9. We've seen this now creep back up. I think you're going to see increased pressure on the 10-year during this time period. The natural, logical question is Chris, hey, what happens with the Fed? Interesting article I posted, by the way. If you guys didn't see this, I didn't post this on all platforms. It's this one here, Shopping from Home. It seems to suggest that working from home causes men to shop more than women. So some of the benefits we're seeing in the economy as it relates to retail spending are from men who are now at home with more time to shop. Again, not my data. That's what the National Bureau of Economic Research is doing instead of looking at recessionary trends. That that seems to be what the data is that they're looking at. So that's a real thing that's out there. All right, let's take a look at. Oh, actually, here. Let's take a different approach. You saw my mullet there. You're welcome. So here's the way it works. The natural logical conclusion is, Chris, what does this mean for the Fed meeting that's going to happen on March 18th? Well, what it really means is nothing. Historically, using wars as a proxy for what the Fed has done, the Fed has taken a wait and see approach on a lot of wartime initiatives, largely because there's supply restraint and government spending, which is necessary for wars, is typically inflationary. A long term war, longer than 3 to 4 weeks, as noted by the president in his most recent statements, would be inflationary and would have much more significant effects. Whereas the near term context of a 3 to 4 week may not be as impactful. Now, we have to be mindful of where we're at. Today is Monday, the 2nd of March. You've got a Fed meeting in literally 2 weeks. So it is clear by the White House's own statements that this controversy will not be resolved by that time. And there wasn't a big probability of an interest rate cut going into that meeting anyway. As a matter of fact, it was almost none. But let's go to the Fed Watch tool anyway, and let's check that out. Go to the screen share here. Here it is. And you've got a 97.4% probability of holding rates. That's what that bad boy is right there. So again, you didn't have a big probability of a rate cut going into it. You certainly don't have a big probability of a rate cut of it now, but they will be discussing the war and some of their thoughts in that particular meeting. And I don't think you're going to see any meaningful change. As a reminder, JP Morgan Chase did have no rate cuts this year and a rate increase in 2027. And it seems that their forecasting may, in fact, be closer to accurate than one may have guessed when it came out. I thought it was a little bit bold when it came out, but it certainly seems to be. Now, I'm not saying they predicted a war or anything like that, but it certainly seems to be that they were not far off from what seems to be happening. So again, we'll watch this all play out over time a little bit and see where that goes, but certainly impactful and interesting. Let's get back to XAI. Let's move from the war topic a little bit to some other topics that are probably not surprising to you, but they're all interrelated. Major U.S. indices recovery rally. NASDAQ and S&P dramatically reversed steep overnight losses in the futures market to turn positive, showing remarkable market resilience in geopolitical tensions. I don't call this remarkable geopolitical, tensions and resilience. I think this is insanity. We have now reached a market where I truly feel that we have gotten to the point where there is total and complete selfishness and deniability. We're so financially vested in what's happening in the markets that we cannot let the markets fail. And I think that this is foolish. I think that a correction, at least in some part, in price, would be wise for the markets, and I think it would be healthy. And I think we saw some of that start to happen with some of the CapEx questioning on some of the spending here. Again, watch our show tomorrow, Tuesday's episode of the Higher Standard Podcast. The full podcast will cover AI in a meaningful way. I think it's going to be very valuable for everybody watching. And I went off. There was a lot of cussing, a lot of expletives, and a lot of rage. So you're getting the calm Zen version today. You're going to get the real pissed off version tomorrow, because it really is pissing me off. I mean, frankly, we are in complete and total denial about what's happening, and we're taking a trust me bro approach to what AI is going to do. And the companies are so eager to make money and change the world in that process that they seemingly don't give a shit about you and me and everybody else along the way, because it's about chasing that dollar and that end result. It's not about the humanity. And this is becoming an increasing problem with society today, where we're ignoring humanity. And you know what? Since I'm on the tangent, let's cover a tangent. I don't like private equity. Okay? Not all of them, certainly. There's always outliers. There's always people who do it from an ethical and moral standpoint. But the whole model of private equity is flawed. Deeply, deeply flawed. And if you want to see an example of it, you can go to my X page, my Threads page, my LinkedIn page, where I covered this. But I posted something earlier today that I think is valuable to read here, because this is part of a problem that's boiling under the surface. That's not exactly what I would call credit risk, but it's certainly a risk to the economy that, in my mind, is materializing, because the rules of the game have changed in such a way that it has made this business model almost impossible to execute without hurting the humans in between, because that's the only way you can really eke out the necessary profits, okay? Private equity firms were involved in 54%, 19 of 35, the largest U.S. corporate bankruptcies in 2025, specifically those with over $1 billion in liabilities. While private equity-owned firms represent only 7% of the U.S. economy, they accounted for 10% of all corporate bankruptcies. The model didn't start off as a glorified Ponzi scheme, but it certainly appears, at least to me, to have evolved into one. And that's going to rub some people the wrong way. Good, it should. It should be provocative. It should get you going. It should make you think a lot about what these companies are in fact doing and how they're doing it, okay? And again, this does not apply to everybody, but certainly a lot of them. This happens for three distinct reasons. One, too much capital chasing too few good deals. If you and everybody else are chasing the same thing, guess what? That value goes up and it makes that deal much, much more difficult to make sense on paper. If I'm paying more money for it and I'm trying to make this a better, more profitable business, I've now got to cover a bigger down payment, if you will. Rates killed the leverage trick. A lot of these companies, private equity companies, were leveraging leverage, using leverage to maximize their returns in accounting plays. And well, guess what? Now the rate environment has come back from what I would call a 15, 16 year of artificial interest rate deflation period. And now you got to play the game with real interest rates that are higher, much, much higher than they were the last 15 to 20 years. And that change has made some of these deals economically unviable, to say the least. But yet some of these private equity companies aren't changing their scope. They're still playing the game. And then number three, multiple expansion is over. Okay, these companies rely on putting together one company with another company, and I'm boiling this down for semantics here. We are taking one company, which is small, another company, which is small. We're mashing them together to make a slightly larger company, and then we're getting efficiencies, i.e., we're getting all the profits, top tier revenue, but we're doing it with half the employees or 25% less employees. And that's boiling it down to brass tacks. That's what you get. And guess what? Then you sell that into the market. But you could argue multiples all day long. If you get a little bit higher multiple, a multiple of revenue, right? Or EBITDA, earnings before interest, taxes, depreciation, and amortization, then guess what? That company goes from being, worth $900 million to $1 billion, and that extra $100 million is just pure profit if you can sell the thing. So that expansion of multiples growing and growing and growing, meaning that it's worth multiples more than it once was, that's coming to an end. And that's problematic for private equity companies and certainly the market. PE returns are often paper gains, not realizations that thanks to mark-to-model accounting. That's not a Ponzi, but it does rely on a narrative continuation and relies on a takeout, which leads to the next problem. Exits are generally dependent on a bigger fool theory. And that's where this is Ponzi-like. If the only way you make money is relying on somebody else to come along and buy you out of your current position, it's not too dissimilar from new money coming into an investment structure that I can pay the old money with, because I'm relying on new money continuing to come in greater dollar amounts than the old money that came in originally, so I can pay back those investors with new money. Well, guess what? This is not too dissimilar. The only difference is that you're paying back shareholders with new money, relying on a greater fool theory, which is very Ponzi scheme-like, or a Ponzi adjacent, if you will, although legal, okay? So particularly when the value created by these private equity companies largely comes from using cheaper debt or ubiquitous operational improvement language, okay? Which really means cost cuts. They're coming in, mashing two companies together and cutting costs. What they do in the very beginning, they come in, they take one company, they'll try to do what they can to lay off people, improve efficiency, and then mash with another company and sell it off. But this is a very quick turn model, typically 3 to 5 years at the longest for private equity. And that's it, because they've got that maturation cycle kicks in. They can't hold the debt for that long. They certainly don't want to do anything that's going to hold their money and tie it up forever. And they want to take advantage of the current market that they're in. And going out much longer than that is ill-advised at best. Private equity's secret sauce isn't genius, okay? Despite the fact that it's, sexy terms, big money. It's got to be something brilliant. It's not. It's not brilliant. It's just accounting, okay? It's math. Above ethics and humanity justified by ego. High leverage, short hold periods, dividend recaps, and multiple expansion do more work than earnings before interest, taxes, and depreciation, amortization, EBITDA growth. Meaning you're not making a whole lot more money. What you're doing is you're holding this for a short period of time with high leverage. You're you're using dividends and recapitalizing that as a company. And then multiple expansion, you're going to sell it for more and more of a multiple of that earnings revenue. Isn't going up anymore. So, I mean, that's the only reason you make money. Well, guess what? This creates the illusion of value creation while employees get squeezed and pushed out. Balance sheets are engineered and get fragile, leaving long-term resilience problems. And this is why you're seeing the uptick in bankruptcies. Most private equity doesn't care about creating value. It manages time, volatility, and optics until additional capital pools can absorb the asset, meaning the greater fool, the other buyer coming along and buying what they have engineered to look like a good business. We came in, we're so brilliant. We've turned this thing around and now we're going to sell it to you. That's also what used car salesmen say when they get a new car on the lot. Hey, I bought it from this guy for $3,000. He didn't want it anymore. I'm going to sell it to you for $7,000. But look, I made all these improvements. Drive it off the lot. It's yours. It's yours. That's private equity. It doesn't sound so genius when you put it that way, but that's in fact what they do, just with smarter accounting practices in order to squeeze out that equity to get it done. Sometimes that capital pool doesn't come along. That's when you get a bankruptcy. Other times the takeout capital can't manifest real value, particularly when they realize that private equity has a tendency to destroy any semblance of corporate culture. Because when you're coming in to a company and you're going to come in as private equity and you're going to try to make operational improvements, what's the one thing that everybody fears? Losing their job. And what's the one thing you're probably going to do? You're going to fire people because you think you can run a company better. And this is the part that blows me away. In almost every single private equity deal I've ever seen, the person that comes in has never actually been an operator. There's someone looking at financials from a balance sheet perspective, from an accounting perspective, and they're trying to make the numbers look a certain way, but they do not care about the humans behind those numbers. They only care about how to structure, how to financially engineer that balance sheet to get it to market to make the most amount of money in that time. Fine, that's your business. I don't judge you. But here's the problem. The humans in the company, from an actual operator's perspective, I've seen what it does to them. And it's disgusting. It demoralizes. It takes a huge chunk out of people's soul. And they got to live there and work there so your balance sheet can have those numbers as private equity. And it's a terrible thing in the market. And you're starting to see those bankruptcies that are private equity related creep up. We've all seen certain examples of this in the markets recently. I do expect the private capital stress that we're seeing in the credit markets, if the markets do go the other way, these firms will have a whole hell of a lot of trouble liquidating these to their LPs and GPs and making money on those investments. So I am off my soapbox. For those of you who thought you're going to get a more subdued show, I apologize. Apparently, you're not going to get a subdued show. I'm a little sassy despite my best laid plans of mice and men. Let's check the comments a little bit, see how you guys are doing over here. I haven't been watching a whole lot. You got, let's see here, 5 stars. Thoughts on account? Okay, there we go. So there you go. There's an agree with. White Hat Master, I agree with you. They won't let the market fail no matter what until the midterms. Yes, and that's also a great point, and I'm glad you made that. So not only do you have kind of the timeline of what I laid out for the stock market and for the political provocation that you have with this war with Iran, but you also have this. The midterm elections are coming up, and you're going to see a whole lot of action, both in policy and frankly in statements made leading up to the midterms, because the Republicans currently control the House, the Senate, and the White House. So because of that, you got a problem, and that's majority rule, and they want to keep that majority rule. So that's certainly part of it. Jason, let's see what we got here. Here. Excellent delivery, Ray PE. Lived through it a few times myself. Yeah, there you go. And I think anybody who's lived through the private equity debacle can speak to it from a human capacity perspective. And again, I've met some brilliant people in private equity. It's not to judge everybody out there. And I know some big names that I think very highly of who are engaged with private equity. But I do think that it used to be that in business, the companies had a commitment back to us as the people, that we gave them a lifetime of work for pensions, for a wage that kept up with inflation. And I don't think that those things are still on the table. And I think the reason why is because there's an unfair expectation of companies, frankly, where as a former executive at a publicly traded company, I can tell you that the expectation is the company makes more money every single quarter. You continue to grow, continue to scale, continue to grow, continue to scale. And that going back the other way slams your stock price because you didn't meet expectations. You didn't meet expectations. Well, you know what? I wish that life was linear. And I wish it looked like that. But unfortunately, in this chart, zoomed out far enough, it really looks like this. Right? And these peaks and valleys are normal, healthy financial activity. Yet we penalize anybody who does this. Looking at NVIDIA's earnings as a great example of this entire concept, NVIDIA has had 13 consecutive beats of earnings expectations. 13. 13 quarters of making more money than people thought. At some point, that merry-go-round stops, okay? And you know what? The market's going to go, they suck, and the price is going to suffer because of it. That is insane. That is absolutely insane that a company has 1/4 of an earnings miss and the market will lose its mind. Now, a good company will try to telegraph that, try to talk to their analysts, try to be prepared and be, forthcoming with that information. But it certainly is a real problem that I think is underappreciated in the markets as where they are now. It's why a lot of people think the markets are rigged. That's why you look at something that you see today and you go, okay, why are the markets up? It's too big to fail at this particular juncture, as I'm sure how a lot of people feel about it. Let's get into a little more XAI. I went right into the Iran controversy stuff and the major U.S. indices, but I'm going to cover this as well. Bitcoin breaks 70K resistance. Saeed, I know you're out there, and I know you're probably really upset by this, so you can turn away. You can look away. It's fine. But your wet paper towel hands, they're going to be upset now. Okay, so it isn't quite at 70,000 still. It's actually closer to 68.9, but still a better improvement. You saw a 36,000 increase. And for those of you who don't know, Jane Street was sued by Terraform Labs because they said that Jane Street, who works with BlackRock to fulfill their Bitcoin ETF, was manipulating the stock price, so the price of Bitcoin every single day. And there was something known as a 10 a.m. dump, where every single day at 10 a.m., the price of Bitcoin would fall. Somebody was trading under the market, driving prices down. And that's, in fact, what stopped once Jane Street was sued for this behavior. And, of course, after they stopped, after the lawsuit happened, after the 10 a.m. pump stopped, a lot of rhyming there, everybody else now, Michael Saylor and everybody and their mother is now suing Jane Street as well. So they're suggesting that they have been the bar, if you will, to Bitcoin's breakout. I don't think that's it entirely, but the current prevailing theory is that Jane Street may have been behind the 2022 crypto winter, which also drove a huge value drop back then. So it remains to be seen. For me, I would beg to ask one question, okay? If one company, i.e. Jane Street, can impact the price this big of a deal, let's just say they are behind the 2022 crypto winter, or they're behind this, approximate 50% drop, that's scary. Do we want our currency that easy to be manipulated? I understand that foreign countries do manipulate, i.e. China, manipulate our currency all the time, buying bonds and all sorts of secondary market cheeky shenanigans. But do we want one company to be able to move cryptocurrency like this? And how do we prevent this? These are more esoteric questions, but there's certainly things that we should think about, because if that's actually true, and we're going to see some litigation around this, that's something we've got to think about as a way to prevent from happening. You can't have that level of volatility over time. And maybe it's just you get to the height of Bitcoin and it just doesn't. I don't know. I don't know enough about it. There's probably some experts out there that'll tell us why that's going to be prevented at some point in time. But as of right now, I don't know the answer. So if you're watching the show and you're in the comments, let me know. Saeed, I see you out there. I'll drop your comment here on the big screen because I love you. UAE stock markets to close for 2 days to avoid possible meltdown, not to mention an Amazon data center in the Middle East, UAE getting hit. Sheesh. Yeah. So I will anecdotally add some color there as well. You've also seen Claude go down recently, which is my preferred LLM currently. But yeah, was that tied to the Amazon data center? Who knows? You've seen all sorts of weird things happen. And one of the things which has been surprising to me is that it looks like the United States has not protected the Middle Eastern parties that are represented in that area, the constituents on the map that I showed you earlier. It looks like they've allowed, for example, oil and gas and energy production plants to be hit. It looks bad. The U.S., who've gone to war with these people, I hope has communicated with them. Can you know, 68.9, what's the explanation for the dip this time? There being no real explanation for the last dip. Well, Jane Street site actually is the explanation for both dips. If the lawsuits are to be believed, again, innocent until proven guilty, but the proximity to those things not happening. Back to finish my previous thought, yeah, it looks like the United States did not protect all those outlying countries: Kuwait, Oman, Doha, I mean, in cities, and you're not seeing what I would think to be the protection. Maybe they have their own, maybe they communicate in advance. We'll see over time how a lot of this stuff happens, but certainly a stock market in one of these countries shutting down for 2 days is a very bad thing, particularly when you have to understand there's some very, very wealthy institutions and investors and families in those regions. And if their markets are getting shut down due to volatility of a war that we are having with Iran, and our markets are seemingly thriving, and if we'll go to the status here, and still in a narrow tech-led rally, I'm sure their money's invested in some of these markets, but they're going to be increasingly more frustrated because they are dealing with the ramifications that we are not seeing in our current markets, and they're going to say, you started a war in the Middle East by attacking first, and your markets are seemingly healthy, but we are paying the price in our markets, effectively being shut down, if not being bombed and physically being harassed there, attacked there. So that consternation between nations is going to build up, and it's going to lead people to make decisions. Right? You've seen the UK saying they'll support, but they won't, but they will, but they won't. You've seen the French President Emmanuel Macron come out and said that they're going to make more nuclear weapons. I mean, you've seen a lot of rhetoric here that seems to be very scary. In the very beginning of these days, early days, it's just rhetoric, but keep an eye on it. This is not going away, and frankly, as much as our market is in denial, I don't know how sustainable that really is. At some point in time, these decisions do in fact come home to roost. There is a little bit more here from a technical perspective on the XAI chart that I did want to cover. I hope you guys are interested in seeing more of it, but let's go into some things. I saw this earlier, and I thought this was interesting as well. South Korean market volatility. South Korea's ETF EWY saw a record $6.2 billion in trading volume spike, while foreign investors sold $4.7 billion in Korean stocks amid regional tensions. That was interesting to me. Massive volume spikes with foreign outflows suggest capitulation selling, contrarian opportunity if regional tensions don't escalate further. So this is what I would have expect to see with regional tensions in our market, was some volatility trading. And yet here we are looking at our synthetic volatility index with a lower than we previously had score. It's certainly not calm, but well within the normal range. You know, it tends to be 40 to 60, and we're sitting at a nice healthy 74, broadly led by less cross-market volatility. There is no volatility in our markets that are significant. You're seeing some intraday stress, you're seeing some realized volatility, but again, there is really no volatility here. And as a result of this, you got a market that does not appear to be afraid, and you don't have to take my word for it. You don't have to take my word for it at all. As a matter of fact, let's go out to the more normalized barometer for this, and let's look at the VIX, VIX. And yeah, I mean, the VIX is elevated, but it's not elevated to where I would call scary bad. This is 20.51. Again, anything above 20 is considered to be elevated risk in my mind, but this is barely above it. This is, in my mind, meaningful, but is it to the point where people are going like, oh, I'm not going to invest, I'm going to pull back, we're going to a bearish market? No, you're not seeing that here. You're not seeing that at all. Oh, what you're seeing is a circle on my face. I'm sure some people think that's appropriate. Those are my horns. This is what happens if you give me a pencil in too much time and wait. Oh, I had a 300 milligram version of one of these this morning. Wow, that's a big difference between the usual can pops. So yeah, don't do that. Don't be me. All right, let's get back to the synthetic. I'm sorry, let's get back to the XAI before we go into some of the forecasting stuff here. Inflation expectation rising. Okay, so this has to do with a lot of what I told you about from the wartime perspective as it relates to government spending. So let's read what AI says. A U.S. short-dated CPI swap surged with one-year contrarian rising 11 basis points, 2.62, indicating growth. Inflation concerns amid Middle Eastern conflict. I think that's an absolutely reasonable concern. Inflation swap spike may be temporary war premium if conflicts de-escalate quickly. This presents shorting opportunity in inflationary expectations. Yeah, maybe. I don't think you should ever short inflation. I think inflation as it is right now seems to be a little bit unstable. We've seen some of the core inflation come out recently. But certainly we saw service costs go up, whereas products costs went down. I say it's too early to call it. Don't take bets on things that are too early to call is my generalized philosophy here. I don't like that. And then this one I thought was crazy. Global fund, equity fund record inflows. You can't see the rest of it there. International equity funds posted 38.1 billion in inflows last week, with 1.1 trillion year to date, putting 2025 on track for a record annual inflow of fund money into funds. Record inflows during geopolitical stress shows powerful underlying bullish momentum. Any major dip likely to be aggressively bought. Think that through. Think that through. The behavioral economics here don't make any sense. It's like people don't care anymore. And maybe some of this is just what social media has done to us. Maybe we've gotten so desensitized to stigmatizing conversations that we get scared and then we just move right back on like it's just not a thing anymore. It's I look at this and I think to myself, how did the U.S. launch a war in another country and our stock markets open up positive? And sure, it's not going to be Iraq. We're not going to occupy the country. It sounds like, at least now. Things do change, but it seems like this denial of what likely could happen in the region, and it's uncomfortable. And maybe that's our attention spans are just weakening, or again, maybe there's just too much money invested. And everybody, and what this essentially is saying with the XAI like print here is it's basically saying that every investor was like, okay, well, the markets are going to dip. And as they dip, this is a buying opportunity because they're going to shoot right back up. Okay, that only works until it doesn't. I did like a little dance there. It only works until it doesn't. And then after that, it becomes you bought what you thought was an opportunity and you just lose a ton of money as a result because the market doesn't recover near term. And the market, as we know now, appears to be overvalued. So for anybody to think that these things are going to self-resolve, I think is frankly reckless at best here. But yeah, it makes me very, very uncomfortable with how all this happens, and we'll see what the midterms give us. We'll see what everybody else says in the meantime. Let's go out to the Twitter sphere. Part of the show is engaging and seeing what's going on in Twitter and seeing what's going on in the real world. I like to look at it in real time. I think you guys should too. I'm going to go over to our social view here. All right, today we're expanding LLM. Lots of AI stuff coming up in my feed. Lots of stuff, and maybe this is because I just happen to talk a lot about it on the show. It's probably a good time to talk about this. I do talk a lot about AI in the show, and this is supposed to be a financial podcast. It is, but the reason why I talk about this is that it is such a revolutionary change to the landscape that is impacting the business world, as you've seen through our market status in tech-led rallies. Tech-led, which is largely AI at this point in time, is driving forward. The QQQ is pulling the economy forward. And AI is the biggest technology, the biggest segment in pulling us all forward. And everything else circles into that, whether the semis, the energy production, everything comes from AI. So you kind of have to talk about this and be in this conversation at all times. So for those of you who don't like the AI rhetoric and dialogue, I apologize. This is not supposed to be a solely tech-focused show, but we talk about it so much that we're actually tech and business on platforms like Spotify, where you don't get to choose what you are. They just tell you what you are. So I think that's going to be a part of our perpetual conversations in the months and days and weeks to come. If anybody's interested, I'm happy to talk a lot about some of the AI agentic stuff that we're doing. I just don't want to bore anybody, but we are certainly engaging on the show with it and playing with it in a way that we think is meaningful and will help people out in the future. Kobisi Letter, one of my favorite pages to follow. The investors are rushing into international stocks at a record pace. What we just talked about, Global Equity Fund posted 38.1 billion of inflows last week. We got some chart work, kids. Let's take a look at the chart. You know, I'm a big fan of chart work here. This goes to show you equity fund flow cumulative in the $1 billion. Wow. So 2021 saw a pretty good spike here, but certainly look at 2025 and 2026, even 2024, massive volumes here after what I would call were down years. So interesting. South Korea led the rush with 3.7 billion of inflows. I love the South Korean market. Frankly, I love the people there and the culture, but sensational. And there's an interesting comment here I think is worth reading. It's a classic buy America move, as in goodbye, not as in purchase, right? Money chasing cheaper opportunities, emerging market momentum, especially Asia, ex-China in spots, excluding China in spots, and maybe some hedging against whatever tariff or policy chaos comes next under Trump. Let's not ignore that we're still sitting at a 15% tariff situation after SCOTUS, the Supreme Court of the United States, rendered the tariffs illegal, and that still remains an open question mark. When this rotation reverses, it could get ugly fast. Still, right now, the appetite for non-U.S. equities feels insatiable. Okay, wow. There you go, insatiable. That's a solid comment. Shout out to Obi Lewis, which almost looks like oblivious. Is it? Is it a reference? I don't know. We'll see. Let's see what else we got here on the social sphere. I want to go back down here to my social view. Most Americans are oblivious to the fact that Social Security checks could be slashed by 20% as soon as 6 years from now. Trump realizing war is actually bullish. That's funny. Oh yeah. My article on energy is spot on. I continue to believe that we need to allocate into energy sector for the coming years in current rotations. Yeah, we said this on the show. Sonny, you do watch the show a lot, and I appreciate you a great deal. We've said this a lot on the show too. We think the energy sector is going to be very bullish in the years to come. Energy and banks in particular. I think banks are more of a near-term play, particularly the M&A side of community regionals. But certainly, we think the energy sector, the QQQ, are here to stay. And I'm beginning to think that cryptocurrency, with a lot of the regulatory zeitgeist that's changing on it, might be here to stay as well. I hope that it does well, but again, I'm waiting to see kind of the anchor of the currency be used by mainstream. And for me, that anchor will be when we see much more blockchain adoption and less cryptocurrency. Right now, cryptocurrency is owning the payments that go into the vehicle, but the real value of Web3 to me has always been the blockchain, and it is so underutilized right now. Every piece of real estate in the country across the world should have blockchain. Every time you go into a store and buy something, your receipt should be on the blockchain. Authenticity this way becomes a much different animal. I know there's privacy concerns and issues, and I'm sure there's a way to address some of that with codes and biometrics. But for right now, blockchain to me still remains to be the most undervalued asset. Once that adopts, you have AI, blockchain, cryptocurrency just goes to the moon. I mean, it's just a rocket ship at that point in time. But for right now, it seems to be that adoption is like a over the table, like anecdotal conversation, which is also strange to me. And again, crypto experts out there, let me know what you think. Inverse Kramer strikes again on CNBC this morning. Kramer said that he loves AVAV. It's down 19% today. He also made some comments that I posted on in my feeds not too long ago. Former Treasury Secretary Yellen said, depending on how long the Iran controversy conflict affects the oil markets, there may be both a hit to the U.S. economic growth and increased inflationary pressures, complicating the job market for the Federal Reserve. I feel like I could be Treasury Secretary if that's her insight. Thank you, Janet. I appreciate your feedback. This idiot who has a live stream show can do the same observation. So I don't know how impressed I'm supposed to be by that. Home sales slumps compare California versus the U.S. I'm going to take a look at that article later on to see if there's anything meaningful there. But I did post something that I thought was interesting. I didn't realize until I was talking to Saeed this morning. Hey, look, that's me doing a live, talking to you on the live. That's weird. This is the unemployment rate in California. I thought this was really fascinating. California is one of the leaders here. Let's go to the wider screenshot here. California is one of the leaders here. You can't see it, but California is at 5.5% unemployment rate versus the national unemployment rate, which is 4.4%. And all the darker colors you see here, which you probably can make out in a bit, regardless of what feed you're on, the darker colors are higher unemployment, the lighter colors are lower unemployment. And I was kind of shocked to see California is above the average of 5.5. It makes sense with all the exodus in the companies. You've got some states over here. Looks like Delaware is at 5.2, Jersey's at 5.4, New York's at 4.6. So again, California, and there's one state I can't make out the state. It may be pointing to Maryland. It's hard to tell based on the chart, but it's at 6.7% down there. But 6.7%, 5.5%, 5.7%, 5.4% appear to be the highest statistical outliers based on this chart. And they are coastal. The Midwest looks really strong. And look at Nebraska and Kansas, 3.8%. Wow, no unemployment there. So, I mean, not a lot of people, I'm assuming, relative to some of the denser MSAs, but definitely a different thing. So we aim to give you on this show the entirety of what you're going to see on CNBC in 1 hour or less. And hopefully we've accomplished that with the behavioral economics being a subtle nod here. We try to acknowledge what's going on in the social sphere. I have done my best to keep these shows to an hour and not meander off the beaten path too long to let you know our thoughts. But right now, the market's going to continue to be in a bit of a wait-and-see, vigilant approach. I urge everyone caution to celebrate victory too soon. I put out a pretty, provocative post over the weekend telling everybody they shouldn't be celebrating yet because regime change is not, in fact, liberation. I stand by that comment that in order to change the regime, you need to liberate the people who then will install a different regime. At least that is my interpretation from a historical perspective. And I don't know that the U.S. has, it's pretty clear in the president's commentary so far that they don't believe they're going to be done for several weeks. And I think that plays the part in what is ultimately regime change, right? You need to have the people get out there and liberate themselves as much as the U.S. take out the leaders, it looks like. That's the plan anyway. So there's still much more to come that's going to impact the markets, the stock market. You're going to see headlines, you're going to see responsiveness, and you are going to see increased volatility if things do escalate. And I do expect they will escalate if we are planning to be there for several weeks at a time, if that makes any sense to any of you out there. For those of you watching on Instagram, Yoshi, I see you out there. Bearded Lawyer, what up, brother? Don Landry's out there. A bunch of people watching the show. This is your time. You can ask questions at this point in time. I'll answer anything. If not, you can always send us an email. It's media@higherstandardpodcast.com. But we're trying to do the best that we can with what we got here from a markets perspective. It is not a political show, but I find myself often commenting on politics a great deal because it's been so heavily impacting the markets as of late. Rosie, I understand the mixed feelings you're having as a Cuban. I want freedom for my people, but I'm not convinced U.S. intervention will change the regime. Cough, cough, Venezuela. And that's a great example. Venezuela has gone effectively by the wayside as far as rhetoric goes. We've heard nothing in the mainstream media about Venezuela in the weeks following that incident. And this goes to I guess, some of your consternation and mine in that we have such a distracted society that social media comes, it hits us with a headline, and we move on to the next headline. We just want that continual dopamine hit from additional headlines. And it's like, look, that's not the way the real world works. Sometimes conflict takes time to work through. And we can't just go in, do something to a country, and then turn to another country like we did with Venezuela. I think that that's foolish, unwise, and frankly, sad. And let's not forget, Ukraine and Russia are still at war. Israel and Palestine have not resolved anything. It looks like, at least unless somebody else has said anything to me, it looks like Israel's fighting a war on both fronts. Again, we I guess skate over these sensational and wild things that are happening all over the world, and we ignore that people are literally dying because we want the next headline. And it's just it's provocative. It's crazy. And I don't really have an answer for it other than the fact that my job here with you, my promise is to watch the markets in good faith and honestly, and it makes me sad. So I apologize, Rosie, and everybody else who's watching who might be a little bit discouraged by the tone of this particular show. It is a lot less sarcastic and a lot less rage-based because I am uncertain of what's going to happen. I'm only certain that something will happen, and that something that will happen will be you'll see reactions in the market to it. I don't think that this entire market positivity that we're seeing here with synthetic volatility index, I don't think this is normal. I think the first trading day after a war has been declared while there's still rhetoric going on should have more volatility than this. That is not normal. I don't think that this is normal. I don't think having a tech-led rally while we are engaging in geopolitical warfare is normal in any way, shape, or form. And if you guys know our sector analysis, one of the things that we look at a whole lot are the energy and supply sector stocks. So I'm going to go into that right now here. Geopolitical and supply risk. This entire cohort of the sector of the stock market, Exxon, Chevron, Conoco, Schlumberger, and EOG Resources, these are all energy and commodities. We know the energy and commodity market, whether small or large, is being impacted right now through a strait which is going to significantly change the deliveries to the Asian markets, not just China, 84% delivery to the Asian markets. And yet we're seeing a positive up buy trend because people want to buy an opportunity they see here. There's no nice way to put this that's politically correct and baby-eared. That's fucking insane. This is literally a geopolitical and supply risk cohort in the sector, and we are seeing it. Well, the president's speaking right now, by the way. You guys are probably watching him, not me. So I'm going to end this show quickly on that note. But this is insane. Keep an eye on the market. Stay safe. Value your families and your friends. Spend time with people that you care and love. We appreciate you watching the show. We will always bring you the honest truth. Watch tomorrow's show. It is meaningful. If you want to support us, go to joinfridays.com. Enter code HIGHER. You get $100 off your first order. Beautiful stuff. I do highly recommend the NAD. Until next time, everybody, we love you and we appreciate you. Bye.